Gotta drop the links. We are live. Live. Gotta drop the links. We live here. All right, give me a second. Happy Tuesday, guys. We're about to get started. Day 3 of the Texas Heist free trading boot camp. Okay, share this link with a friend. Lots of games going to be given right now. Okay, give me a second. Let's go and find everything quick. Hope y'all having a good Tuesday, man. Took some killer trades that we're gonna break down at the end of the stream. So make sure you stay. If you were patient enough to watch through yesterday, lots of game was given at the end. So for the people that made it through, they benefited. Okay. Alrighty. Let's see. Do. All right, about to get started, guys. Make sure you got a pen and paper, man. Take notes. Take notes. Day 3. Alrighty, I think we are live. Day 3. Let's go. Hold up. Texas Heist. All right, 706, come on. Let's get started, man. Thanks, guys, for being here. Day 3 of the trading boot camp. Hopefully, you watched day 1 and day 2. Day 3, we're going to be talking about risk management. Okay. So with risk management, risk management is everything. If you don't have any risk, it doesn't matter how good you are in trading. It doesn't matter what type of system you have. Without risk management, you're gonna blow your account every single time. Okay. When it comes to trading, man, trading is real. Okay, this is not a joke. I know, we're at home, we're pressing buttons and doing all of that. We're not doing physical labor. But with trading, there's a lot of mental warfare that goes on, man. Okay, making decisions. Okay, so with risk management, it kind of gives you a peace of mind. Okay, so yeah, you might be trading your hard-earned real money or a prop firm account. Regardless, with proper risk management, that is how you achieve profitability. Okay. So we have liquid extractions. He's gonna go ahead and start it off, and then I will come in later, and then maybe a colossal trader, because we all kind of look at risk management a little bit differently. We look at it the same way, but we're still a little still different. So we all gonna give you pointers on how we tackle risk management. Cool. All right, man. Start us off, liquid. Liquid.
Yes, sir. Yes, sir. How you doing, fellas? How you doing, everybody? Today we're discussing risk management and how to mitigate risk while we are trading properly. So there are three different parameters to risk that I like to involve. And this is me personally. I don't know if you guys can vouch for this as well. But the first risk is time. Do I have enough time to sit in this trade? Because time is one of the biggest things that can help us or break us, depending on how we position ourselves in the market. Number two, I would say, is patience. Time and patience are two different things. Patience could be you taking your time into entering a position, and timing could be you coming to the charts at a certain time during the day. So similar, but two different things. And the third thing I would probably say um, is a parameter of risk is mental capacity. How has your day been going? Um, how has the week been treating you? Have you had any hardships during this week? These are things that affect us before we actually get affected by the market. So we want to try to control these three initial things to have the best optimal trading setups and trading mentality. Um, I'll start off with stop loss discipline. So to every trade, you have a entry point and a exit point. whether your exit point is your stop loss or your take profit. The way we trade, we like to have a tight stop, a constant stop, because in the market, we only want to control things that we can control. Anything we can't control, we don't want to worry about. So we want to have a hard stop of 20 to 30 points per position to preferably position us in a better place in the market to where if we do have to draw down, it isn't as much drawdown and we don't have to see numbers fluctuating too big. That'll also help with our mental capacity. So what I mean by a, a 20-point stop, let's say you have these highs right here that have not been swept. Now, for price to be considered a stop loss, it would have to be some sort of swing high or swing low. And in this case, we have a impulse down. This was the original strong high. We had an impulse down. We created an intermediate low, and that's just short for a short-term low. And we eventually traded back up to the original high. So we would consider this a strong high because it was never liquidated or induced. So from this high, me personally, I like to count 20 to 40 points below it and look for some sort of entry point if we get an entry point from that strong high. And in this case, that would be somewhere between 26, 110, which would be somewhere in here. But we don't have a PD array right here. Even if we drop down, and this isn't for everybody, I'd advise all beginners to stay at the 5 minute and don't go any lower. But if you're a seasoned trader, then okay, by all means, take your time. But as we zoom in, we see that we have a PD array, even though it is a previous PD array. Um, Reusing the same PD arrays will actually help you more than it will hurt you because you already know how price has reacted to them previously. So previously, we have broken down at this PD array. So logically speaking, if we come back to this strong high and we don't break this strong high, I would be expecting price to break down at this previous PD array that we have traded back into. And that would be my notation for an area to enter. And I'll just use this as an example. Um, Before we even impulse down from this PD array, we kind of just traded side to side. And that's not a real direction. And that does not give us an opportunity to place our stop where we want to place it because we don't have the proper information to make that decision. So once we do get an impulse, now we enter at the highest point, which we would also call premium. And from premium to discount, anything above the 50 percentile is high probability, and we would expect it to go in our favor. So for stop loss discipline, the more things that you have to add up to your area of interest that is 20 points away from a strong high, 20 to 30, or however many points are comfortable for you. For me, it's 20 to 30 points from that strong high. Then look for a PD array. After you find your PD array, look to the left and see how it has reacted to the PD array previously. And whatever is done is more than likely going to repeat if price gives you that signal, in which it not liquidating the strong highs is my signal that price is going to trade lower. So now that you have the where we get our stop losses from, which is around a strong high or strong low, count 20, 30 points, find you a PD array and you enter off your PD array. Now that we have that down, we're talking about taking partials and basically seeing where the liquidity is, seeing where your pit stops are during price. Um, Price never moves in one direction at a constant speed unless it's already done its job in liquidating what it had to liquidate. Um, in this case, we consider liquidity a multiplicity of things. Liquidity can be equal highs or equal lows, which these would be equal lows. These would be equal highs, and I'll zoom back out to the 15 so you guys can see what I'm saying. We have equal lows and equal highs. So these are equal lows right here, and these are equal highs. That is a form of liquidity because money rests on both sides. It's too clean. Anywhere where price is smooth, that's where we expect price to go. As you see, the price is smooth here, so price will eventually make its way up here. And previously, price was smooth down here. And as you can see today, price made its way down here and filled all of that. So it can be equal highs, equal lows, some sort of imbalance in which this is an imbalance right here. Any gaps you see, any unfilled candles, any price, any place where price has yet to intercept, we would look at that as a form of liquidity or a form of money that has to be either released or snatched and grabbed. In our case, we would like to snatch and grab it and hold it for potential profit. Um, Partials is very important because in markets like these, you may not get the opportunity to actually hold your trade. Your trade may only run to your first take profit. Let's see if I can find an example of a trade only wanting to run take profit. Your trade will want to run take profit and immediately just reverse. So as a matter of fact, this trade right here, even though this was a good trade and this is a trade that I took, I was expecting more. Um, Price was supposed to trade into this area of liquidity you see fit here. This gap here, I expected this to happen last week. Last week. So in that move, expecting this to happen, what happened today, I got chopped up in the trade that I was currently in and actually got stopped out on one of my positions because I tried to hold for too long. As you can see clearly, the risk management was on point, the stop loss was in the right area. I just didn't have the right area of liquidity marked. I was too greedy. When in reality, smaller time frames is smaller time frame liquidity. So if you're trading off the 5 minute, you need to have 5 minute liquidity mapped so you know where your pit stops are. If you're trading off the 1 minute, you need to have 1 minute liquidity so your pit stops are on the 1 minute. And this just helps to keep you in with price while price is showing you what it wants to do next. You know what I'm saying? Even if you do have higher time frame PD arrays, it will take time to get to those PD arrays. So if you enter off the 1 minute and you're targeting the hour, you still have to track all the candles from the 1 minute up until the hour just to see if you have made any progress or if you're in drawdown. So I would just use 1 minute liquidity or current time frame liquidity for whatever position you use so you can track price and know what price wants to do. We're going to leave that there at taking partials because taking partials is a very important thing. And if you're not taking partials, then you're more than likely going to get turned around and either break even or you're going to get stopped out. You have to learn how to take partials. Um, Next slide. I would assume this is a continuation. So when we talk about taking partials, another way you could benefit from trading your positions. Let's say if you do have a higher time frame point of interest and you enter on the 1 minute. Now, you may see an opportunity to stack contracts. And when I say stack contracts, I mean add on leverage, in which this would be a perfect example. You see a breakdown here and it breaks down, but your original target would be these lows here. If it gets to these lows, you would want it to get to these lows. Now, as you retrace, you're still retracing in profit. You never make it back to your break even stop. So, since you have a PD array under your original entry and you're already at break even, You can pyramid. And pyramiding would be you entering another position at a PD array that is working in your favor. So that would look something like this. And I'll just use this tool to draw this so you can understand
Real
what
quick,
I'm trying
if
to
you can explain to them what a PD array is. Again, we explained this in day one, day two, but when you say PD array, explain exactly and give examples of what those are off the top, so they understand what you're referencing as a PD array.
Okay, so a PD array is a area of interest or an area where we watch price. I don't know, Casey, what is the exact?
So I'll just make it short. So it's a premium and discount array. Premium and discount arrays. That's what they are. So PD arrays are the order blocks, the C4s, the loop zones, the liquidity pools. All of those things are called premium and discount arrays. The reason why it's called PD array, premium meaning if you're if you're trading like the exact trade you're looking at right now, if price drops and trades higher, if it's going higher, it's going and is above the 50% of a range. When it's above the 50% of range, it makes it premium, meaning it's expensive. So any order block, any C4s, any loop zones that are above 50% of a range are considered premium. Anything below are considered discount array. So premium is pretty much premium and discount arrays. The only term the order blocks of C4s can be premium or discount depending on where they are within a specific range. Again, above 50% of a range is a premium discount array. Is I mean it's a premium array. So anything above 50% of a range is a premium. It's expensive. So if price trades above 50%, it's expensive. So any order blocks, C4s, loot zones, breakers, landmines, anything above that becomes a premium array. Now if it's below, if you're trying to buy something, you want to buy in a discount. And in the discount, there's discount arrays. Those discount arrays are still order blocks and C4s. Only thing that makes them different is if they're below the 50% of range, it's a discount. If it's above, it's a premium.
100%. And I would also like to add, in discount, you would like to be buying, in premium, you would like to be selling. So wherever you are, if you're high, you would want to expect low. If you're lower, you would want to expect higher. If you're higher and you expect higher, it would be best to just sit on the sideline, wait for a better setup. Um, so a PD array, back to what I was saying, a PD array in premium, you would look to take that premium PD array to a discount array, which would be a short position to a buy side stop, which would basically be a buy limit or a retail trader entering buying positions looking to go long. Um, the stop being 20 points is a perfect place for you to add on as you retrace into premium because it's higher probably of price working in your favor entering at premium PD arrays that have been liquidated and have already changed character to something bearish. Um, and we only stack if price is working in our favor. We don't add to losing trades. So what I mean by if price is working in our favor is if we sweep some liquidity to the downside, or a direction to the downside. And liquidity, like I said, would be some type of low or high or imbalance or PD array. Just correlate PD array with some sort of liquidity. So in this case, we have lows. Yes, these lows were tagged and created by the original impulse. So that impulse is supposed to technically bring price down higher as the impulse and retrace happened above the 50 percentile. So it stops placed 20 points above where we deem a PD array, a premium array in price. We will wait for price to tap that premium array and we ride price down to the next area of liquidity. And that would either be, once again, some sort of fair value gap, some sort of imbalance, or some sort of low. Now, when it comes to breaking even and trailing our stops, those are two different things, and they both will actually protect you. So, me personally, I only go break even once we sweep some sort of liquidity, whether that be lower or higher. Some sort of liquidity has to be swept before I actually go break even. Now, trailing stops is a bit different. because when I look at trailing my position, I don't look at it as leaving it break even and letting it run. When I want to trail my position, I'm trailing my position because I'm not expecting things to be as smooth as a break even position. So a trailing my position would be something like me watching price run to, or assuming price would run to some form of liquidity in which, as we start getting closer to that level, we start slowing down and potentially reversing. And I could use this as an example right here. I could use this low as an example, as I originally thought this trade would come to this low because that was the cleanest area that price had not touched. The 100% the cleanest area that price has not touched. So me being me, it's like, okay, if price goes to this area, since this is the 5 minute, if price goes to this area, since we have not broken any strong structure on the 5 minute, I have no reason to actually set my position to break even because I have no confirmation. Now I can trail my position as in trail profits as I'm making profits because I'm not as confident in my trade to go where it's supposed to go because of the current market conditions. You guys feel free to add on to anything I'm saying. If let me know if I missed anything. Um,
I would just say, trailing stops. The way I look at it, and I'm making sure, obviously, you're ready. And let me not steal the thunder here because you're obviously making a huge presentation here, and I hope you guys are taking notes and getting the game here. But I'll say when it comes to trailing stops, the way I kind of look at it is if you already have a target, like if you have a target on your charts and price hits your target, but obviously we never know how far price can go. Some days might be a crazy day. So if it's a day where price is going, keeps on dropping and dropping, just like Nasdaq did today, if you look at it, one way you could trail your stop. The reason why you trail your stop, right, is not necessarily because okay, you're not sure of the trade. That's one thing. Another thing could be more like you are also, yeah, you're unsure of how far it can go. So your trade already hit its targets, and now you just move your stop loss very close to price. And how do I typically do that by looking at the last high that's formed on maybe the 1 minute, 5 minute chart, depending on what chart you want to use. But um, I pretty much try to trail the stop loss by any new high created. So once price hits my target, I'm ready taking off, taking most of my position off the table. But I want to allow room for price to keep on going if it wants to keep on going. And in that case, every new high that forms, if it's selling, I'll just put my stop loss above that. Or perhaps if there's a fair value gap that it creates as it keeps on dropping lower, I'll just keep on putting my stop loss lower and lower and lower above a new high formed or above a fair value gap that's formed or loop zone that's formed as it keeps going down. So really just trailing that stop loss as tight as I can so I can also gain more profit, beyond my original target. Because that's going to happen sometimes. You might have a target and it goes way beyond it, and you want to make sure you capture some of that as well.
100%. Anything you'd like to add, Valentine? Hello? I guess
Oh,
not
yo.
listening. Yeah, anything you'd like to add, my guy?
No, 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 not at this point. Not at this point.
Okay,
Y'all
so
doing thank you.
so the next topic we'll go over is basically risk to reward ratio and how to stay, I wouldn't say stay profitable, but how to choose which setups you take to attempt to stay profitable because everything comes down to your execution as a trader. So risking one to make one is a, I guess you could say it's a nice way to trade, but your your just because you have a high win rate does not necessarily mean that you're a successful trader. Um, you can lose a lot of trades with a one-to-one risk to reward, but it won't be as significant as someone who chooses his trades and is very picky with his trades, and each of his trades are a 4-to-1, 3-to-1, or 5-to-1. That means for every dollar you risk, you make three, four, and five. as opposed to you risking $1 to make a dollar. Yes, I understand. Um, you have to accept risk, and you may not be ready to hold your trades, but this is why we dial down to which steps we take, how we take them, when we take them, and the thought process behind um, taking those actual trades. You don't need a high win rate to be a profitable trader. You do not. As long as your risk management is on point and you manage your losses, you could be a 5-to-1 trader who's trading at 20%. That means you will be able to lose 5 trades before you actually lose one um, trade of profit. That's how risk to reward works. So you could take one trade for the week and make 5 times what you risked, and then the next week you can take 5 losses. You'll have a cushion of 5 losses. And most of the time, if you're a profitable trader, once you build up a cushion, you will never come back, um, because you already have a system developed. So I would like, as a new trader, I would stick to 1 to 2, really 1 to 3 max, and I would perfect that. I wouldn't look at anything more than a 1 to 2, 1 to 3. Um, Now, if you're more advanced, if you're more advanced, then of course, more risk, more reward. I'm pretty sure you'll be able to accept the risk, but then you can start looking for 4-to-1s, 5-to-1s. But in looking for those long moves, you have to accept the fact that the trade may take some time to form. You know what I'm saying? Like, since you want to hold longer, you have to allow liquidity to build up. You won't be able to take little 1-to-1 scalps. That won't build your equity in your account. Um, I would just say
Agrees.
take your
So
time,
soft.
keep it. What you say?
Yeah, go ahead. No, go ahead, finish up. I'm
I
gonna
would
add
just
something.
say, yeah, I would just say take your time. There's no need to rush a trade if you don't have the risk reward that you set. And I mean, we control as traders. So we have to have constants. Constants are things that do not change. Risk to reward should not change unless you're experienced and you know how to adjust on the fly. Then your risk to reward should not change. Um, your your entry points as a new beginner, your entry point should not change. Your stop loss should not change. Um, the times you trade should not change. All of these things are things that you're in control of as a trader, and as long as you have those things in control and under control, you can mitigate as many losses as possible because you're being disciplined. Uh, and basically, this is just going back over the stacking leverage rule. However many points your stop loss is, I would add on to another contract, as you're in profit. If your stop loss is 12, add a contract or another position as you trade every 10 points until you hit your target or you hit some sort of place where you want to take partials. Uh, Once again, break even and trade management. We'll go over this one more time, and then I'll let Valentine take over and say a few things. Break even and trade management. The smaller the time frame, the tighter your break even may be. I mean, not your break even, the tighter your stop loss may be, and the quicker your break even may come. So if you're going to be trading on a 1 minute, just know you have to expect to have 1 minute reaction time. Don't go on a 1 minute with a 5 minute reaction time thinking price is going to respect you. Because, yes, I understand all candles are the same and all candles create other candles on different time frames. Price moves so much faster on the 1 minute, and there can be many confusing imbalances and different things that may throw you off as a trader if you're not ready to monitor price on the 1 minute. So stick to your parameters as a trader. Don't go down to no time frames that you're not comfortable on, that you haven't been trading on. And whatever time frame that you're trading on, stick to your levels on that time frame and monitor on that time frame. That's pretty much all I got.
Solid.
That's some solid game, man.
Yeah, I was gonna say a very solid presentation, man. Solid on risk management. I think like as you're walking through it, I'm like, yo, this sounds like a time where we can even just turn this into psychology as well, because the risk with risk is
I
also,
agree.
yeah, it comes to it's risk is psychological management or psychology management, whatever you want to call it,
Hmm.
because even when you're talking about stacking positions, you got to make sure that you understand how much risk you're comfortable with. You should always have an idea of how many contracts, when we're talking about futures. Like for me, I like to trade 3 to 5 minis. Sometimes, I mean micros. Whew, I'm mad at I'm not here. We're gonna get three, 3 to 5 micros is okay for me at this moment. Sometimes I do go to 8, 10, but for the most part, I know that I'm very comfortable with risking 3 to 5 micros. And that could be, for me, that's like $200-300 risk, right? For some folks, they're okay with risking only $100, $50. Point is, you have to figure out what risk, how much you're willing to risk on the trade. What's comfortable for you? You don't want to be in a trade and you're stressed about taking a loss. If that's the case, then you're risking too much. You want to make sure that as you're trading, whatever you have on the table as your risk is something you can afford to lose. And on top of that, you're not going to be too worried about it. You want to make sure you're only worried about what price is doing. So whenever price, let's just say, starts reversing against you, which will happen to most, it's going to happen a lot throughout our careers. If you're in a trade, it's going well, and the price starts coming back, your ability to not be like deer in headlights and your ability to act will also depend on how much you have risk, how much you have on the table, how much you have at risk. Because if you have a regular amount of risk, it might start coming back. You're like, well, this trade is actually no good. It's not good anymore. So you're willing to get out easier. But if you have too much on the table, too much risk on the table, then you're making money way more money than you used to making, right? So you're super excited. And when price starts coming back, y'all know this feeling. Price starts coming back like, ain't no way. I was just up $3,000. And now it's back and you're only up
Yeah.
700. And now you're stuck like, nah, it's gonna keep going, it's gonna keep going. So now you're fighting the battle of the fact that the charts are telling you one thing, but you're so worried about how much money you were making when you're over leveraged that you can't take the right action, get out of the trade, or set it at break even. So to avoid all that, ideally, just make sure that whatever risk you do put on the table, whenever you do decide to put on risk, make sure that it's risk that you're okay with losing. It might be $50, $100, might be $20, 30, 10, whatever it is. Make sure it's something you're comfortable with. So whenever price is doing what it's doing, you can focus on what price is doing and not just focus on how much money you're making or losing.
That's beautiful, man. That's some good psychology talk, man. Hope you guys are taking notes. Um, let me share a few things on my side really quickly, and then I'm gonna go into some charts. Let me get this up here. Mm, let's see. All right, let me put this slideshow. Where is the copy? Cool. Let me share my screen. All right, cool. So I just want to touch on a few things. So let's see over here. All right, so trading, traders versus gamblers. Okay. This is important. Some people think trading is gambling. Um, to me, honestly, that doesn't make sense. I'm going to go into the reasons why trading is not gambling. Um, if I, let's go into it now. I'll get to it at the end. So risk management. Okay. So as a gambler, gamblers really they take large impulsive risk without planning. Okay. Like, yeah, you can be at the casino playing cards, or whatever. But at some point, if you don't have some type of methodology and if you're just doing impulsive actions, which is very easy to have those emotions, gambling, okay? Because like it's very risky, okay? There's not much you can really control sometimes, with gambling, okay? Compared to traders, traders calculate their risk carefully with stop loss and position sizing, okay? So we decide how much, we want to place on a trade, how big, our stop loss is going to be, how much percentage of our accounts we're going to risk. There's more control to it. There's more methodology to it. Okay. Mindset. Gamblers are usually driven with emotion. Okay. Whereas traders rely on discipline and logic with a structured system. Okay. Okay. So now, yes, you can gamble on the charts. Okay. You just pressing buy, sell, impulsive. Okay, you see prices going up, you just enter. Your price is going down. Oh shoot, let me close, let me reverse it. You sell. You're gambling. You don't know you don't know what you're doing at all. Okay, you have no methodology, you have no structured system. Okay, and a structured system is something that you have back tested. Okay, you've gone through the charts and you back tested, and this is a system that's actually getting wins. Okay, it's producing the right bias. You're getting your right entries and you're at least hitting, for me, at least a 3 to 1. Okay. When I was learning, I've had many mentors now, but my most recent mentor, hey, if it's not a 1 to 3, it's he said every trade should offer you a 1 to 3. Okay. If it's not a 1 to 3, so it's your time. Okay. Some might, feel different. But for me personally, I like 1 to 3s. Okay. But 1 to 2s are cool too. You know what I'm saying? Take your partials. Okay. Probability and edge. Gamblers usually rely on luck with no consistent edge. Okay. Um, no, no dirt on, sports betting. But to me, man, I don't know, like, I don't know the methodology behind it. Like, how are you gonna predict how someone is gonna play? Like nothing is really in your hands, You're not talking to this person, hey, fumble. I mean, I hope y'all saw the news of Chauncey Billups, Terry Rozier, they were actually out there doing that. But there
No,
was sports
no.
betting. Bad job. Like I don't know. Sports betting, I just don't get it. You might as well take that money, save it, come to the Texas Heist page, learn how to trade, and you better off using trading that money. Okay. All right, cool. So once again, gamblers rely on luck with no consistent edge, while traders base decisions on probabilities and their system. Okay, probabilities. Okay, once again, nothing is for sure, even in life. It ain't for sure. I'm gonna wake up tomorrow. I'm gonna drive, and God forbid, I get in a car accident. I live life in probabilities. Okay, so when with your trading, once you get into the charts, you need to ask yourself, what was the probability that price can go to this high? Okay. And then you're going to base that probability off of your system. Okay. Splash bang. Okay. Inverse loop zone. Okay. Pull back to OTE. Okay. Expansion during New York after news. Okay. Like all of these things need to factor in to make that trade a high probability trade. Okay. So, yeah, second. Yeah,
You still there, brother?
yeah, I'm here.
Okay, now I thought you went out for a second, but nah,
All right,
that
cool.
that
Let me do
that
more.
was that was so far. Hey, that's solid right there, man. Like you
Yeah,
said,
that's real
life.
solid, bro.
People
Yeah.
don't understand. Like when they look at trading, they think it's gambling stuff like that. I'm happy you broke it down this way, but everything in life is a gamble. You know, whether even if you're just going to school to go get a degree and you come out like no one's get. I mean, look what happened with AI right now. So you
Yep.
you went to school all them years, and the AI comes and takes your job. So it's not
Mm-mm-mm.
guaranteed that you're gonna go to school, come out, get a degree, and then find a job. And some people have done all that and they still can't find a job. So the whole point of trading is to make sure that we don't have no bosses. We are our own bosses. We can
Yes,
execute on
sir.
our own. We make money whenever we want to make money. We wake up, make some money. We can be in a whole other country making dollars, living life
Yes,
differently than
sir.
everyone else.
Yes, sir. Yes,
So, so,
sir.
so that's the goal. And again,
Yeah.
it's everything in life. If you want to call it a gamble, is a gamble. Everything has probabilities. It's a real thing. It's not about gambling. Everything has probabilities. So the way you tilt it, even when you do business, your business is not guaranteed to succeed. It could be as simple as a car wash business. You put in the wrong spot, you're taking on risk. You take on risk. It's either gonna make you some money or lose you some money. And depending on what that does, you can adjust your system. That's same with trading. Once you have a model, have something that repeats, you have an edge in the market. Every business, Walmart, Amazon, they have an edge that makes them successful. Same with trading. It's about finding your edge. When you find that edge, you're gonna apply it. Sometimes you're gonna lose. Sometimes Walmart, Amazon has lawsuits. Sometimes they have an outage. That's business as usual. Same thing with trading. Trading is about finding your edge, applying it to the charts, and when you do take some losses, you adjust. When there's a major change, and you feel like your edge is not working anymore, you adjust. Same with businesses. Business is war. You obviously got to constantly adjust what you're doing in order to just remain successful. So same with business. It's all about probabilities and having the edge.
Beautiful, beautiful. All right. Next is let's see, perspective. Okay. So gamblers usually focus on short-term gains, okay? Just trying to make a quick dollar. Hey, I'm about to fly to Vegas, man. I'm feeling lucky today, man. Go play some poker or whatever. Okay. Short-term gains, okay? It's not sustainable. Okay. While traders focus on consistent profits and longevity in the market. Okay. Now this is very important, okay? Longevity in the market, okay? That's even more uh, that's even more nah, it's same. But longevity in the market is very important. Now, what do I mean by that? One is okay, you can be traded. Let's say you have $1,000, okay? Maybe you're risking $50 per trade, whatever, okay? You can be taking L's, okay? You can be making wins. You can be taking L's. You can be making wins. You can kind of your equity curve can kind of just be consolidated, okay? Which sometimes is fine, okay? Number one, it means that you know how to stay in the game. You know how to stay in the game. Yeah, you're taking losses. Yeah, you're making wins, but maybe okay, you now take two losses. You know what I'm saying? But you know how to stay in the game. Longevity in the markets. Okay, and the more you stay in the game, the better you can learn. Okay, and then two, not blown accounts. Okay, as a beginner, as you start off, you might blow some accounts, which is fine. We have all blown lots of accounts. We've all blown lots of preference accounts. That's fine. Okay, but once again, you always want to make sure that you don't beat yourself down too much. Okay, this skill set we're trying to do, this skill set we're trying to learn, this industry we're in. Like I said, what not 98 people, 98% of people quit. Okay, so we're trying to do something that's very hard. Okay, it's like going to the NBA. Okay, it's not easy. Everyone's trying to hoop. Okay, but only if you're in the NBA making millions. Okay, but guess what? We can make billions too, faster than them. You feel me? Okay, so this is my NBA. So I'm trying to be the best. So longevity in the game, man. Look at LeBron James, man. Look at LeBron James. I think this is his second injury or third injury. Ain't even a serious injury. He ain't never broke his arm. He ain't never like ACL or none of that, man. Longevity in the game. That's why he's the king, man. All right. So that's some perspective, man. Okay. And then risk of ruin. Okay. Gamblers are more prone to losing everything due to reckless behavior, while traders mitigate this by ensuring no single loss can wipe out their accounts. Okay. So now this brings me into how much you should be risking, per account. I might have that slide in. Let me see. Okay, yeah. So no single trade should be blowing your account. Okay. So you should not be risking 100% of your account in one trade. So you have $1,000, you're risking $1,000. Okay. That's a gamble. You might as well go flip a coin. Okay. You're not doing that. Okay. Not at the Texas Heist, at least. Okay, so things you should know: win rate. Liquid extraction already went over win rate. Uh, Win rate is cool, but sometimes you don't need a high win rate to be profitable. Okay, which is why you need to really focus on risk to reward ratio. Okay, this is very important. Like I said, once again, I like to go from one to threes. Okay, I have $100. Cool. Okay, I catch a one to three. Okay, just make 300. Cool. Now, the next trade, I'm trying to go for a one to three again. Cool. I hit a one to three. I'm up 600. Okay. Now I can take two losses. I lose 200. I'm still up 400. Okay. Compared to taking like a one-to-one trade. Okay. You risk $100 to get $100. Okay. The next trade, you haven't built any cushion. You haven't built any real cushion. Okay. So, um, and at least with this with risk to reward ratio, I like to compare trading to the NBA a lot. But at least for me, I'm gonna give you guys my methodology going into the week, man. Sunday, Monday, man, I'm trying to take it easy. Okay. So what does that mean? I'm trying to go for a layup. Okay. I might go for a layup, a nice little post fade. I'm gonna try and get inside. I'm trying to get my feet wet and get myself going. Okay. Now, translating that to trading, I'm not going Sunday, Monday, big lots. Okay. I'm usually starting off small. Okay. The week starting. Let me get my feet wet. Let me get a few layups, a few good trades. Okay. Build my cushion. Okay. Build my confidence. Cool. I'm going. Okay. Step back, mid range. Cool. Okay. Shots are falling. Okay, you take the next shot, you miss the trade. That's fine. Okay. But right now your field goal is like, you're 4 or 5. Cool. Okay, keep doing your thing, back test. Trading session is done. Just don't go chill. Review your trades, back test. Okay, you come back the next day, cool, you're feeling good, you have some cushion. Hey, you find the A+ setup, everything is lining up, flash bang, that daily loot zone, landmine is there. What I'm saying, everything is, it's wide open, the vault is wide open. Now you can hit that step back contested three. Okay, now you might throw on 5 micros, now you might throw on 10 micros. Cool. Okay. And from there, that's how you really, in my eyes, really propel. Okay. And that's how you really gauge. Okay. So that's how you really scale. Start off small, build that confidence, and then go for that 3-pointer. Okay.
Yeah, that's solid. Very, very solid. Heating up here, but I want to go back to win rate for a second. Like, I think it's very important that we all understand, like, your win rate. Have a real understanding of your win rate, right? No, you can stay on that slide. I mean, yeah, that's cool. Either one matter, doesn't matter. But what I'm saying is this: you're not gonna be 100% from the field. So let's just wipe that out of our minds already. You're not gonna be 90%. You're not gonna be 80%. You're not gonna be 70%. You're not gonna be 6. Look, the markets with just a 40% win rate. Most people, let's just keep it real, right? 40%, 50% is cool, right? If you're taking less trades, but even 30% win rate, just understand that you're gonna lose a lot. That's what I'm trying to make you understand. You're gonna lose a lot. But it's about how you manage your risk, and then again having that the right risk to reward. If your win rate is 40%, the numbers are right there in front of you. But if your win rate is 40%, maybe you need to have a 1 to 5 target only, a 1 to 3 target only. So you want to pay attention. What is the model? What's my risk reward model based off of my win rate? But I really want to touch on win rate because people sometimes, yes, yes, we have very precise entries and things of that nature, definitely. But does not mean that our strike rate is like 100%, 90%, 80%, 70%, right? We take losing trades. That's part of trading. That's part of life, period. You're gonna lose. And you need to make sure you're prepared. You have a sober mind about it. That way you're not putting out too much risk. You need to have a sober mind. If you look at percentages of the best baseball players, their hit rates, we're talking about 30%. Basketball, we're talking about 40%, 50%, 30%. So in any skill set that people have, right? I mean, hopefully if you're a brain surgeon, you have a way higher percentage of that. But any other skill set, right? That's not life or death. The percentage, the win rate is not necessarily like in over 50%. You can do very, very well with less than 50% of a win rate. So just keep in mind you're gonna lose a lot and make sure you understand that. Therefore, adjust your risk accordingly and don't have $1,000 in your bank account and risk $1,000. That's stupid. It's gambling.
No do, no do.
No, I just want to add that
Uh,
in.
all right, no, solid, solid. All right, cool. Let me go back a slide. Okay. So risk reward TP, stop loss. Cool. I'm gonna go over some examples about that. Risk per trade. Okay, so there's many conversations about risk per trade. Okay, some people I've had mentors say, "Hey, don't risk more than 1% per trade." Okay, I actually just watched an interview, a podcast with Larry Williams. Titles up tomorrow. Go check that out. Larry Williams has 60 years of experience, 63 years of experience, excuse me. And if you know ICT, the only person he's ever mentioned was Larry Williams. Okay, so that should say a lot. But Larry Williams, he said, 4%. Okay, should be some 4%. Okay, so I'm actually gonna have to look into that. Do some calculation, at least for myself and my accounts, and see what that looks like because. Risking 4%, cash me a nice 3 to 1. I'm up 12%. That's nice. That's nice. Okay. So I gotta think about that. But risk per trade, you should not be risking honestly more than 20%, 30%. You should not be doing any of that because that's not longevity. Okay. If you're risking 30% per trade, you only have like three trades and your account is damn near gone. Okay. So once again, this comes back to longevity in the markets. Okay. Very important. Okay. And then position sizing. Okay. Position sizing, knowing how much, your lot size is, what you're going to use. Something recently I have implemented is staying at a consistent lot size, okay? Having a tight range. So whether that's 5 to 6 micros or that's 1 to 2 lots, okay? But not having your lot size fluctuate. Okay, one day you pop in a lot, the next day you pop in 5 lots. Okay, so now let me just take it throw a scenario. Cool, you have $1,000. Cool, okay. Let's say you trade in gold, micros, or whatever. Okay, you placing on two micros. Okay, you just made some money. Okay, let's say you made like 400. Okay, you're feeling good, right? You're feeling good, right? All right, cool. So now with that, you now take another trade. Okay, and with that. With the two micros, let's say you make another 400. Okay. So now you're feeling good. Okay. You're feeling like King Kong. Okay. So now your next trade, instead of 2 micros, you want to up it to 6. Okay. So now you already made $800, and now this next trade you're placing 6 micros, and you've been placing 2 micros. Okay. So now this is 6 micros. You take the trade, boom, you take that loss. Now, because you up that loss size, that one trade can wipe out that whole $800 in one loss. Okay. So this is why it's very important to be consistent with your position sizing. Okay. The only time you should be up in that lot size is when you're honestly trading good. Okay. I'm not talking about 1 or 2 trades or nothing like that. Okay. As a beginner, um, there was this person back in the day, his name was Don Vo. Okay. He would be placing 10 lots on gold, 10 lots on gold. And he was winning. Okay. He was growing his account. He 100x his account, you know what I'm saying? But he kept still using the same 10 lots. And I just thought about it. I'm like, so you're placing 10 lots, you're making money. And as you're making this money, you're still using the same 10 lots. So really, all you're doing is just decreasing your risk because as your account is growing, you're not having these wild swings. Okay. So you're really just decreasing your risk. Okay. As your account grows, you're still using the same lot size. Okay. So that's why it's very important to like, you gotta know your game. You gotta know yourself. You gotta stay in your lane. Okay. You gotta crawl before you walk and walk before you run. Don't come out here, pop in small lot sizes, and now this next trade you're trying to go big and you're trying to over leverage. Okay. No, we don't do that. Okay. So as when you're beginning, say, hey, I'm only gonna pop 1 or 2 micros only. Okay. And then stick with that for like a month. See how you do. Are you doing good? Okay, now you upgraded. Okay. All right, cool. So I think yeah, okay, that covers that. Y'all got anything to add before I hit the charts? Ooh-wee. Hold on. Gold.
I don't have
Hold on,
anything to
hold
add on my
on.
side. I don't have nothing to add on my side, but that was solid so far. I hope you guys took the notes and took, there's a lot of game given here. Very, very solid so far. Only at the Texas Heist.
Yeah, the Texas. It's not gold is dropping like it's hot. Okay, cool.
And that's been
Well, Back Snatcher, you in? Heist.
Nasdaq fell too.
It did, man. This market's dropping it. Yeah, yeah, markets is moving. All right, let me break down a few charts. So we've talked about TP stop loss, we've talked about it, but you really need some visuals, you need some live practices. So let's go ahead and get into that, okay? Let's go to, let me delete some things off here. All right, beautiful. Okay, so um, if you watched day two yesterday, we talked about gold and actually had a nice gold sell today. Okay. So let me go ahead and break that down for you guys. So let's turn on midnight really quickly. Okay. And then let's hit that 15-minute. Nice, cool. All right, so this was yesterday's. Oops, what happened? All right, there we go. All right, so this was Monday's price action. Okay. Really consolidating price action. Once again, the sells were expected because, like we said, as long as we stay beneath this daily loot zone, okay, we are bearish. Okay. So with here, you see flashbang drops, comes back, another flashbang drops, okay, built up liquidity over here, built up liquidity, okay. So this is telling you sell. So now, for example, something like this, okay, and let's give a live example. Actually, take I did take this trade. Yes, I did. Hold on. Now we're at TP that. Okay. So first, let's go ahead and break down the play. London really kind of consolidating. Once again, we were bearish. Once we swept up and hit this flashbang, once again, guys, once we hit a high, we're either going to close above it or we're going to wick off. Wick off, and we go ahead and drop aggressively. Okay. We drop. We now come back into this loot zone, into this 5-minute loot zone. Okay. That pushed price down. Okay. And as you can see, more built up equal lows. Okay. Which is good. Price is consolidating. And price is consolidating, well, what do we want to see? We usually want to see some type of flashbang. Okay. We want to distraught everyone before we run up in the bank. Okay. So right here, we had this 5-minute loot zone. Okay. It's 5-minute loot zone. Equal lows down here, liquidity. Okay. So as price came up here and had this flashbang, I had a sell limit in this 5-minute loop zone sit in. And then now my stop loss is going to be above here. So stop loss placement is very important. Okay. You don't want to jam your stop loss or you never want to jam your stop loss. You want to put your stop loss where like, hey, if price hits this point, I know I'm totally wrong. Okay. So I've had in the past jamming my stop loss, and that has caused me to miss many great trades. Okay. So for this example, if you're entering this 5-minute loot zone, okay, you want to put your stop loss above this swing high right here. Okay. This swing high push price all the way down. So this should be respected if price is truly bearish. Okay. So with this, you get in here, and then, like I said, I usually like to target the 3 to 1s. So with this trade, I believe once, and so this is also gonna come into how I kind of manage my trades, which goes into risk management. Okay, so let's actually do a bar replay. Let me press some buttons, man. Let me press some buttons. Let me press some buttons. Okay, so we're getting into this trade. Cool. And then for this one, you can also put it in the bodies. So I'm gonna put my stop loss up here. So cool. I mentioned this trade. Okay. I'm risking $276. Okay. Once again, find your vaults, your liquidity points. One is right here, and then we also have this loot zone that's wide open over here. Okay, so this can also be an area where you can also take profit. Okay, loot zones, but we just don't TP at at highs and lows at the liquidity point. You can also use a loot zone or fair value gap as a form of profit taking. So it is, this could be in your TP1, and then this would have been your TP2, something like this, okay? And then this could have been your final TP, okay? So in this trade, um, once price hit down here, I went ahead and took partial. So this is how this would play out, okay? So now for me personally, once price starts dropping, so boom, price just made this high, price made this higher low, and then price failed to make a higher high. Okay. So whenever we form a high, price is usually more than likely going to come back and want to retest that high. And we're either going to make a new higher high or we're going to respect this high, make a lower high. So once price made this lower high and price starts falling down, for me personally, this is when I can now move my stop loss. And I moved my stop loss right here above this fair value gap. Okay. So that is now me also mitigating my risk, lowering how much I'm now losing because I am now seeing structure coming into play. Okay. I am now seeing structure come into play. We hit this loot zone. Look at how this closed. Look at this high. We never closed above this high. Drops. Boom. This is significant. Drops. I can now move my stop loss from here to here. And then now I'm chilling. Okay. So now look at how, let me do that again. Look at how, not that. Look at how this trade went from at least to this first vault. Look at how this trade went from a 2-to-1, okay, to now a a 4-to-1. Once I now mitigate my risk based off of structure. And once again, this only comes with intuition. Okay. I'm just giving you guys a sneak peek into kind of how I look at things. Okay. But as a beginner, I recommend just accepting your risk, leaving your stop loss where it is, and letting the trade play out. Okay. So just giving you guys some advanced game, something from my tool bag that I use. Okay. Let this play out. So boom, right there. At this point, I went ahead and took partials. Okay. TP1 got smacked. And look how this loot zone, the top of it got smacked to a T. Okay. So at this point, I had already caught obviously a 4-to-1 and now a 6-to-1. So at this point, where did TP, where did the trade go? So at that point, I'm taking partials and now I am now setting break even. So I had 3 micros in. What I would do is I would close out 2 micros. I would have 1 micro running and this at break even. Okay. So that's kind of a little bit into risk management. And once again, make sure you're not risking too much. Okay. Make sure you're risking something that you can stomach. Okay. Something that you can place a trade and you can go to sleep and not be worrying. Okay. That's very important. Okay. All right. So now let me go ahead and talk about this gold sells that took today. Okay. Very beautiful sells. So we had this drop, boom, into this loot zone. Okay. And now we come into Asian session. So Asian session really just kind of consolidated. Nothing to do there. Okay. With that consolidation, London now comes and takes out Asian lows. Okay. We take that out, and what do we now do? We run up and we take Asia highs. Okay. Now this right here is important. Consolidating price manipulates down to the downside, doesn't take out this low because we're leaving this low for New York session. Now it rallies up to take out Asian highs. So Asian, like whatever they're buying or selling, each side got liquidated. Okay. And now before I went to bed, I noticed we had this loot zone. Let me turn off midnight open. I noticed that we had this 1 hour loot zone right here. This candle's low to this candle's high, 1 hour loot zone. I went ahead and put a nice um sell limit there. Okay. And to add to that confluence, guys, once again, if you've been paying attention, showing how this trade came into and this house came into play. Okay. Flashbang, boom. A big expansion to the downside. High to low, if you're looking to sell, you want to sell in premium above the 50%. Okay. You want to now find a PD array that is above the 50% in premium. We have this 1 hour loot zone, the only 1 hour loot zone within this whole structure. And also with that 1 hour loot zone, guess what we have? We have a landmine. We have this landmine, this 1 hour landmine. Okay. Why is this a landmine or an ICT breaker? This is the structured low that pushed price up to take out liquidity and cause a flashbang. So once we now close beneath this low, okay, that is now also a market structure shift, okay, and now this will make this area of an area of resistance to push price down, okay. So once again, this is um a 1 hour landmine, 1 hour loot zone, okay. So all these confluences are very important. And then look at how we go ahead and we take out Asia highs and we consolidate here. Okay. Once we hit this high, lower high drops, and then right almost before New York, we go ahead and take out this high, and then we start dropping. Okay. So this was a very clean trade, very smooth. Let me take you guys down to the 5 minute. So just details, flashbang. So once again, even if you miss this 1 hour loot zone, this is how you still could execute it. We have a high, we take it out. Do we close above it? No, we drop, and then we have this boom, this big drop. We have now taken out this low. Okay, now took out that low. Structure shift. Okay, because this is the high that pushed price up to cause this flashbang and take out this high over here. Okay, so we took out this high over here. Let me draw that out. We took out that high. Okay. So now with that, once we now retrace, okay, here's your loot zone. Wide open. She's wide open. Boom. Okay. So now with a trade like this, you're gonna enter here. Stop loss. Actually, let's do a replay. Start new. I'm gonna actually execute this. Stop loss will be up here above this high because this high should not get taken out. It's been respected so far. This should not get taken out. Okay. Stop loss, and then where's our TP? Liquidity down here. These equal lows, just like that. Okay. That right there is a 4-to-1, almost a 5-to-1. That right there is a solid trade. Now with this trade, depending on how much you want to risk, you can risk 2%. Okay. You risk 2% and you're making like 10%. Okay, so that's a nice trade. So in this trade, let's go ahead and pop um 3 micros. Okay, so once again, I like to stick between 2 to 3 micros. Risking 270. Okay, and then let's see what price does. Nice drop, nice drop. Not doing anything. Okay, so now at this point, okay, me personally, like liquid extraction says, liquid extraction probably said break even or something like this. Okay, I would probably do set break even too. Now this is a risk-free trade. I'm already up money. I'm already up 700. This is a risk-free trade. So you can either put your stop loss above this high. So now instead of risking 267, you're now risking $111. Okay. And now that actually now takes your risk and reward to almost a 9 to 1. Okay. I'm gonna wait for TP to get smacked. Boom. And with this drop right here, this was a glorious drop. Okay. Oops. This is when I took profit. Once we started closing bullish, okay, my mindset was like, okay, yo, this is almost a 17 to 1. Okay. And now, because we had this big expansion, guys, make sure you go back to watch day one. We have a drop, we have a consolidation, we have some type of small manipulation, but this is really consolidation. After price consolidates, price is going to do one thing only. It's going to expand. Consolidation, expansion, always. Expand to the downside, a small retracements, then a big expansion. So with this big expansion, I was like, hey, I'm already up a good amount of profits. Oh, what happened? Come on. Da, 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 da. Oops. I'm already up a good amount of profits. Okay. And I know price is probably going to retrace. Okay. So I went ahead and peeled off the profits. Okay. So that was a great trade. Um, a really great trade for me today. And then you can see that price is just going to retrace back above the 50%. You want to sell again, you sell above 50%. We had this 1 hour loot zone. Okay. And then price drops it like it's hot. Okay. So that's a little sneak peek into risk management. Hope you guys found that insightful. Once again, just chart time, chart time, chart time, chart time. Okay. And then, for psychology wise, I would definitely recommend, reading some books. Go ahead and read the book Trading in the Zone. That is a great book.
That is a great book
Uh,
for sure.
a great book. What else can I think of? Go to YouTube. Go ahead and watch Mark Douglas. Okay, on YouTube. That is great. Okay, great social psychology for trading. The other one I would recommend that is very popular is Words of Wisdom. Okay. So Words of Wisdom is a podcast where he's interviewing like top traders, people with like 40, 30 years of experience. Okay. So a trading podcast is very essential because the people that are doing it that are successful, you definitely want to know what's going on in their mind. You want to see how they view the markets. Maybe there's a thing or two that they might drop that you might take home that would change your trading, trading trajectory, immensely. Okay. So you can also watch Titans of Tomorrow. Okay. There's an interview with Larry Williams. Okay, 63 years of experience. Okay, so someone that's 63 years of experience. Hey, anything you're saying, I'm trying to hear that. Okay.
Mm-hmm. Mm-hmm.
So it's like basketball, man. You
Facts.
know what I'm saying? I think over the summer, Victor Wembanyama, he was working out with Hakeem Olajuwon, the dream. Okay. So once again, you want to go to people that have done what you're trying to do. You want to get that game. Okay. And honestly, trading podcasts, I don't know how it's free. The cheat. It's a cheat code. Okay. So uh, I always say trading is 90% psychology, 10% skill. Um, so make sure you just, always working on your mindset. Trading is it's really just a big mirror. Okay. If you're not disciplined in real life, if you eat bad, if you don't wake up early, if you have no structure in your life, trading is just going to amplify all of that. Okay. So that's all I
Mm.
got. You got any liquid extraction you want to add on before we end it up?
You pretty much hit it all on the nail, bro. Very, very solid presentation, bro. You covered a lot of corners. All I can really say is resilience, man. Show up every day, consistency.
Yeah. Yep. That's it.
That's
That's it.
that's that's the biggest thing. We can stress everything that we already, teach, but at the end of the day, all of that is based on consistency, bro, and repetition, time in the
Yep.
market. So I'm
That's
gonna
it.
put emphasis on don't procrastinate. Just jump in the market. You know what I'm saying? It don't matter if it's live funds. It don't matter if you sim trading. It don't matter if you watching price. Just get those reps in. Just jump in and get to know price. Get personal with it. You know what I'm saying? That's
That's
pretty much
it.
all I can say.
That's 10. Solid, man. So we'll see y'all tomorrow, day four, the last day of the free trade and boot camp. We're basically just going to be putting everything together, kind of like what I just did right now, just putting everything together. We're going to go back in price and just repetition, repetition, repetition. So you guys can see it over and over again, okay? So we talk to y'all tomorrow. Y'all have a blessed night.
Yes, sir.